Everyone talks about compounding like it's a guaranteed path to wealth. Invest consistently, wait patiently, and eventually, your money multiplies. Sounds simple, right? But here's the truth most people never hear. Compounding has a hidden minimum, and if you never cross it, it barely works at all. That's why so many people invest for years, even decades, and still feel like nothing is changing. Today, you're going to understand the line almost nobody talks about, and how crossing it changes everything. Compounding is powerful, but only after a certain point. In theory, it's straightforward. You invest money, it earns returns, and those returns get reinvested to generate even more returns. Over time, this creates exponential growth. But in real life, that exponential curve doesn't start immediately. In fact, for a long time, it looks almost flat. This is where most people get misled. Because when you first start investing, the results are painfully small. You might be consistent. You might be disciplined. You might even be doing everything right, but the numbers don't reflect your effort. Let's say you invest $2,000 and earn 10% in a year. That's $200. Another year? Maybe $220. Even after several years, the growth feels slow, almost insignificant. And that's because you're still below the hidden minimum. The hidden minimum is the level of capital where compounding starts to produce meaningful, noticeable results. Before you reach that level, your returns are technically growing, but practically invisible. Think of it like heating water. You can apply heat for a long time, and nothing seems to happen. The temperature rises slowly, but there's no visible change. Then suddenly, at 100 degrees, it starts to boil. That's the tipping point. Compounding works the same way. For years, it feels like nothing is happening, and then everything starts happening at once. But here's the problem. Most people quit before they reach that boiling point. They expect results too early. They underestimate how much capital they actually need. And they overestimate how fast compounding works in the beginning. So they stop investing, or worse, they start chasing shortcuts, high-risk trades, get-rich-quick schemes, or trends that promise faster returns. But the truth is, compounding isn't slow. It's just delayed. And the delay is where the hidden minimum lives. To understand this better, you need to look at the three forces behind compounding: time, rate of return, and capital. Everyone talks about time. Start early, they say. And yes, time matters. Everyone talks about returns. Earn higher percentages, they say. And yes, that matters too. But almost nobody emphasizes capital enough. Because capital is what determines whether your returns actually mean something. A 10% return sounds great, but 10% on $1,000 is just $100. That's not life-changing. It doesn't pay your rent. It doesn't give you freedom. But 10% on $200,000? That's $20,000. Same percentage. Completely different impact. Until your capital reaches a certain size, compounding feels like a side effect, not a driving force. And that's why the early stage of wealth building is not about compounding, it's about accumulation. This is the phase where your primary job is not to maximize returns, but to maximize contributions. The wealthy understand this deeply. They don't rely on compounding to build their initial wealth. They focus on increasing their income, building skills, creating multiple streams of cash flow, and aggressively investing as much as they can. Because they know something most people don't: compounding only becomes powerful after you've done the hard work of building a solid base. Let's break it down with a simple idea: compounding escape velocity. This is the point where your investment returns start to rival your contributions. Imagine you're investing $1,000 every month. That's $12,000 per year. In the early years, your portfolio might only generate $500 or $1,000 annually in returns. Your contributions are doing almost all the work. But as your portfolio grows, something shifts. Eventually, your investments might generate $12,000 per year, then $20,000, then $30,000. Now your money is contributing as much as, or more than, you are. That's escape velocity. That's when compounding stops feeling slow and starts feeling unstoppable. But getting there requires crossing that hidden minimum, and most people never do. Why? Because they underfund their investments. They save too little. They invest inconsistently. They rely on time alone, thinking that starting early is enough. But starting early with small amounts and never increasing them can keep you stuck below the threshold for decades. Time helps, but time alone is not the solution. You need scale. You need to grow your capital aggressively, especially in the early years. That means focusing on increasing your income. Because every extra dollar you invest doesn't just add to your portfolio, it accelerates your journey to the tipping point. If you double your monthly investment, you don't just double your results, you drastically shorten the time it takes to reach meaningful compounding. This is why high-income skills, side hustles, and business ventures are so important in the beginning. Not because they're better than investing, but because they fuel investing. They help you cross the hidden minimum faster. Another mistake people make is obsessing over returns too early. They spend hours trying to find the perfect stock, the best crypto, or the highest yield investment. But when your capital is small, optimizing returns doesn't move the needle much. For example, increasing your return from 8% to 12% on $5,000 only adds a couple $100 per year. That's not transformational. But increasing your capital from $5,000 to $50,000? That changes everything. So instead of chasing higher returns, focus on increasing your input. Earn more. Save more. Invest more. Because once you cross that hidden minimum, even average returns can create extraordinary outcomes. And here's the part most people don't realize. After the threshold, compounding feels effortless. Your portfolio starts growing faster without you doing much differently. The same habits that felt slow and frustrating suddenly produce visible, exciting results. This is where motivation flips. Instead of wondering if it's working, you can see that it's working. Instead of forcing consistency, consistency becomes natural, because you're seeing the rewards. And this is why the early phase is so critical. It's not supposed to feel rewarding. It's supposed to feel like work. You're building the foundation. You're pushing the boulder uphill. But once you reach the top, gravity takes over. The boulder rolls on its own. And the longer it rolls, the faster it goes. So if you feel like compounding isn't working for you yet, don't panic. You're probably just below the hidden minimum. Focus on increasing your income, investing aggressively, and staying consistent long enough to cross that threshold. Because once you do, everything changes. If you want more breakdowns like this, real wealth strategies that most people overlook, make sure you subscribe and turn on notifications. Because the difference between struggling for decades and building real wealth faster is understanding how the game actually works.